Let's get started with my presentation and talk about macro and some of the ideas that we've been gaining conviction and also refreshing our views or things that we believe are relevant in this macro environment we're living now. This is one of the most important charts of this whole presentation. It's a lot of the slides that come subsequently are perhaps some of the reasons why I've been gaining more conviction on this. And I believe so. I don't want to speak for Kevin, but I believe he is becoming of the same view as well. This has been sort of an evolution of views. I mean, back 6 months ago, certainly we were not of the view that we are today, especially with yields. I think that this new administration and the policy changes we've seen throughout the last, call it 6 months, have certainly changed a lot of our opinions. But this chart specifically is something that reminds me a lot of listening to Stanley Druckenmiller when he used to talk about how he made most of the money in his career by shorting 2-year yields prior to major economic downturns. And I think the mix of policies that we're dealing with now and the level of concentration in markets is setting the stage for something very similar. I think that the 2-year yield, as shown in this chart, historically tends to roll over quite significantly, and potentially we could be at the beginning of something similar now. And this is going to be the reasoning behind it as we move along in the slides. One chart that I think it's remarkable is this U.S. policy uncertainty index that has been spiking recently. That's the red line you're looking at. It's spiking, second largest spike or surge that we've seen in the history of the index. The prior time was actually the COVID crisis, understandably surged at that period. But it has a very strong correlation or link with credit spreads. As I said this before in prior presentations, I've always been of the view that junk credit spreads are a very good representation of risk in the markets, complacency. When you are very complacent in terms of a market environment, you tend to see credit spreads be very tight. I actually had a research not too long ago. Right now, junk spreads are about 3.19. That basically showed that the only other time in history that the junk bond stayed below 3% for as long as it did recently, which just recently actually went above that 3 handle, was in July of 2007. And 2 months after that print, we actually saw volatility picking up during that time as the global financial crisis unfolded. Now, I think that this period is different regarding the set of outcomes that are creating the potential for a downturn in the market. But at the same time, I believe this is the white line is likely to increase substantially given the level of uncertainty. In other words, credit spreads are not reflecting what we think is the appropriate risk in markets right now, and why we think this is so relevant. If we go to the next chart, there's another way of measuring some sort of either uncertainty or risk in markets. And this is by Apollo, chief economist. And you can see here University of Michigan, which came out in March 14th, so a week ago, exactly a week ago, that had expected business conditions in a year by believe consumers. And showing much percentage of those consumers believe it's getting worse, and it's the worst printed in the history of this index as well, which has got a very long history, as you can see in the chart. Now, you have to question. Okay, well, some other folks said, well, we've seen other times when that happened, and yes, that they kind of were linked to recessions and so forth. But the big story here is not even that. To me, the big story is actually the fact that 2-year yields are way too high relative to where the risk in the economy really is. The credit spreads is just another way of seeing that in the prior chart. But in this case, specifically, we're looking at the economy, deterioration of the economy, at least on the conditions perceived by consumers. And potentially, this could be also adding to that case. Magnificent Seven stocks are also something that have been leading the market over the last few years. And now we're finally seeing, more officially, this part of the market is not responding well. In fact, it's actually technically or officially in the bear market. And so down about 20%. And even with the recent rebound of the market, we didn't really see Magnificent Seven actually lead the way. In fact, if you look at consumer discretionary part of the market as well, outside of technology, which is mostly what you see in Magnificent Seven, you're also having trouble seeing any type of resilience. In fact, we're seeing the other side of that too. This is probably the chart of the day of that I've seen, at least today, but I think this was posted maybe 15 or 18 hours ago. The Federal Reserve lending outstanding and select programs, and so they basically aggregated a bunch of different programs that the Fed was running to supplement some sort of issues that we're having in the economy at different times. Some of them being the bank term funding program and or even the Fed discount window borrowing, and some of those related to the banking problems we had in 2023. But the point being is that all that supplementary stimulus that the Fed was providing in the market has actually not been provided anymore. So as you can see in the chart, those things have run out, and maybe that is even more relevant than austerity, which maybe the jury is still out on the effectiveness of Doge and all those efforts that we're seeing from the administration to reduce spending potentially, but maybe would explain some of the tightness in monetary conditions recently, and what maybe also justifies the decline we've seen in equity markets. It's probably related to this chart that you're looking at the screen. It's a very very good chart that illustrates lack of liquidity coming from the Fed. So the Fed comes out and points that today, or I should say 2 days ago, that they're not going to be be cutting rates anytime soon here. At least there's no further confirmation relative to what the market is. Market is pointing to a direction of about a few cuts by the end of the year, and at the same time you have Powell taking a stance that to me is actually quite hawkish. I don't remember who, but I saw somebody saying something along the lines of it is important to know that this also happened in 2018. We saw a similar strategy by the Fed, of which Trump and the Fed were not getting along, and the Trump administration was basically forcing the Federal Reserve to cut rates and stimulate the economy through that, and eventually that happened. But prior to this, we actually saw a large sell-off in equity markets. That was 2018, of which I remember that very well because we had substantial amount of short exposure at that time as well in our funds. But as you can see, there's another point out of this too. What Trump is saying with this tweet is not just forcing the Fed, but he's also making a point of that a lot of these policies that we're seeing from the Treasury side or from the government side, or if we want to separate the Fed and the others, you can see that rate cuts. That's what I wrote there in this slide. That's just my view, by the way, and I think the rate cuts are necessary to ease or alleviate the strain from austerity, tariffs, and immigration policies. I mean, it's not just austerity. It's not just trying to accomplish reducing wasteful spending and all sorts of things. It's also tariffs will have a weight on initially on economics or the economic growth. But immigration policy is, in my view, very underrated, and in terms of how much impact it could have in the economy. So the longer the Fed actually keep rates at these levels, the more damage it could be to the economy. And in my view, more damage you can see in the 2-year yield, because that's where the market really prices in recession, and where you tend to see that number actually starting to really say that we may see bigger problems ahead. On the other side of all this, you have the Fed, and under a lot of pressure. You have the government trying to cut spending. You have Europe going to a different direction, which is interesting because we got to understand from a global macro standpoint, what does that do to currencies and other things? And Germany just came out with approving a package of about $1 trillion to on defense and infrastructure spending, which questions, again, the inflation problem. It questions a lot of things, actually, and potentially drives yields higher, right? And it's I think what we're seeing recently of European yields, especially in the long end, moving substantially higher recently, have a lot to do with this. What people are not seeing is that there's a difference between what happens in the yield or in European bond environment versus what could happen with the currency side. When you have interest rates rising in Europe, and you have on the other side in the US a pressure to lower rates, that creates a rise in interest rate differentials that tends to have an impact on the currency markets. And this is the chart that I noticed. By the way, if you go back to the 1990s, a lot of currencies had a very strong correlation with interest rate differentials. And today, most of these currencies have lost some of that. And as you can see in this chart, this relationship potentially is coming back. And you can see this, the euro versus the dollar is in I believe it's in blue, and you can see. Sorry, is it blue? Yes, it is blue. And the other one, interest rate differential, is in white. And you can see in this chart as well that the interest rate differential is potentially actually signaling that there is more appreciation for the euro ahead of us. And I'm a believer of that. I do think that the dollar is extremely overvalued for many reasons, and interest rate differential is just adds to that point for many in many ways. Another thing that it's been happening, and I think it's again off the radar and potentially has a lot of significance to the markets overall, is notice that first, the dollar is having its worst year-to-date performance in 30 years. Nobody is really paying attention to this, but not too long ago, I believe it was maybe 2 to 3 weeks ago, markets were down about 4% or so. I think NASDAQ and S&P 500 were down about the same amount, 3 to 4% for the week. And I saw the dollar down about the same amount. That brought my attention. I went back in history and looked at and plotted those performances over the years, and that was the worst performance of the dollar, given that how much the market was down. We're entering a different environment. A lot of people are still, under the assumption that we're entering similar to '08, when markets go down, the dollar goes up. That's not my view at all. I do think that we're about to see is a change of what is supposed to work as a safe haven. Gold being one option, and in this case, in the near term, even the 2-year yield may actually act as a great hedge, in my view, as the market continues to falter. And why does this interest rate differential matter so much? I've mentioned this before. This chart is such an important aspect to the whole picture of currencies. And I said many times, and I believe it's one of the most important charts for policymakers, is the fact that we have interest payments to GDP in the US at about almost double, triple or in some cases even 5 times more than other countries. And so the U.S. is in this sense of urgency to cut rates much more than other countries. As we see that occurring, again, when I say cut rates, I'm not talking about just the Fed. I'm talking about the entire curve, just like Scott Bessent has said, and I listened to him very closely. What he said is, I want the entire curve to go down. It's not just the 10-year, the 30-year, the 7-year, the 2-year. It's the entire curve needs to come down, and he's not wrong about that. That's the easiest way to reduce fiscal spending. But that has consequences, right? As we see government spending declining, this is an older chart that we put out in 2024 in July on the ladder that I think it's very relevant to now. I guess things have not really changed. They're starting to change. We're starting to see the rebalancing. But this chart shows you, first, in average, I call American fiscal exceptionalism. And we've seen the U.S. spend about 8.1% of GDP in fiscal spending, annually, in average, since 2009. And you look back with all these other countries, clearly, we haven't seen anything like this. We don't have any other country that is anywhere close to the U.S. in terms of that. Japan is one, but the U.S. is by far, in terms of pro-growth spending, is the largest amount. Although it has a large entitlement amount, there's a lot of pro-growth that actually cause growth in the U.S. to be stronger than in other countries. And that explains the bottom of this chart, which is the performance of U.S. equities versus the rest of the world. That you can see this, straight up line going up, from the left quarter, downward quarter to the right side, upper quarter of the bottom panel of this chart. Clearly going up significantly over the last decade or so. And what does that do if we start seeing a shift away from American exceptionalism? And while I do think that the chart that you're seeing in the bottom is probably going to look like the other way, it's probably going to go, and start a downward trend, that a lot of people are not positioned accordingly. Not only that, but also potentially, we could see other countries doing substantially better than we've seen. That chart was about maybe 7 or maybe 9 months ago. And you can see that now we're seeing one of the best performances year to date for global equities relative to U.S. equities, at least in the history of this chart. This is substantial. It's not just the dollar. These things are all linked. It's the dollar's having its worst year. U.S. equities, or global equities versus U.S. equities are having the best year. Do you see the link? Does that make sense? I mean, yes, it makes sense. It makes a lot of sense that we're seeing all these things connected in a big way. And then we're seeing European equities do very well. So on the left, let's look at the top there. Maybe I'll use my cursor on this if I can. I don't see it. There we go. Yeah. So you can see on the left here, you can see the Euro area versus US, and huge move on the blue line. On the green line, the same. You see over here, Germany equities have been doing very well versus US. And then at the bottom, you see the long term. And the long term is completely different, right? I mean, it's only barely damaged or barely made any difference in the chart over the long term, because the chart you're looking at the bottom is exactly the same chart as this one at the bottom, right? But inversed. And so we're just at the beginning of these transitions, in my view, and I think it's going to be very exciting for investors as we see money flowing out of the U.S. into other places, especially natural resources. And as I said before, there's two types of imbalances happening in the U.S. There's an imbalance internationally and an imbalance domestically. The international imbalance is the fact that we have MSCI weightings of 73% U.S. equities, and all other economies have basically, single digits of weights. So U.S. equities are getting much higher weight than any other country in the world. No, when I say much higher, I'm talking about substantially higher, right? And then on the other side of this, you have also domestically the fact that concentration is very high across a selective number of names. It's the Mag 7 technology sector that have been benefiting tremendously. What happens as we see the rotation out of those concentrated areas of the market into others? Is where there's risk and opportunities. Let's talk about something else that we've been talking about for a long time that I think it's also a long-term trend. Is the gold to S&P 500 ratio. We've seen that ratio reach four-year highs recently. And the real question was, okay, well, 4-year highs, what does that mean? Well, if you recall, there was a research we've done that looked at yield curve inversions. When you have a substantial amount of yield curve inversions, above 70% to be exact, basically that triggers some of the best I should say assets, a combination of asset classes that tend to perform well is actually the gold to S&P 500 ratio. And there are many reasons for that. Sometimes it's gold that does its own thing. Sometimes it's both. You have gold rising, S&P 500 falling, and sometimes you have S&P 500 falling, extremely, it very significantly, while gold, kind of holds its ground quite significantly, like it was in '08. Gold did decline in 2008 during that initial part, especially of the global financial crisis. But the S&P 500 had an even larger decline that caused the ratio to actually increase. So what I'm trying to say is that today we're seeing both parts of that trade working, or both parts of these asset classes working, the short S&P and the long gold. And in my view, this is the beginning of a trend, because historically these things tend to work for another 2 to 3 years, as we see the S&P 500 getting into trouble and gold actually becoming a better hedge as a haven asset. And and so I think this is just the beginning of a much bigger trend as well. In fact, if you go a little deeper, something that's been out of the conventional thought about markets has been the chart that I just put on the screen, which is the S&P 500 down year to date and gold miners up 33%. Well, a lot of people think that gold miners should be down when the S&P 500 is down. And I know a lot of people are looking at today's action and say, well, gold miners are down, Tavi, and that's okay. Those daily moves, nobody can predict. But you see the trend here. There's a clear separation, the rotation happening. That maybe under the radar, maybe people are starting to notice. Certainly people are noticing, like European equities doing better. More people coming out saying they're bullish. It is very interesting. Warren Buffett adding to his positions on Japanese equities. Are you noticing the trend? I mean, there's a lot of similar patterns. But to me, there's another thing that hasn't really, performed as well. And you can see here silver miners, as a great example of gold miners doing very well, and would expect silver miners to start performing well too. They are doing very well, but you look at monthly, even with the decline today, monthly these silver miners are about to break out from a major resistance. Going back to 2011 or so, and that could maybe the beginning of a real breakout in my view. And I'm paying very close attention to this. And the fact that we have silver specifically, not even silver miners, trading at where it is, call it, between 32 to 35, it's been kind of in that range. And the gold to silver ratio is still at near 90. You look at this ratio, we don't usually stay at these levels for too long. So I believe we're getting close to a moment where this ratio starts to really fall hard. And wouldn't surprise me if that happens in the following weeks, especially as we get the quarterly close here soon. So I'm starting to think that the derivatives of gold are starting to look extremely attractive, even relative to gold. The miners, silver, and even if gold falls, the miners are making a lot of money right now. In terms of free cash flow, in terms of bottom line in their businesses, given the fact that their cost structure remains, almost half where gold prices are today. Gold prices go down to 2,500. Let's say it's a pretty large decline in prices. You would still see those margins to be very significant relative to history. So it's remarkable that not a lot of people are paying attention to that. Maybe we're in a new age or at the beginning of a new age of mining, in my view.